$23 million in record net income for the second quarter of 2026.
And a diluted earnings per share of $1.35.
Both of those were up 5% from just the first quarter. We are jumping right into a deep dive on Camden National Corporation today.
Yeah, Northern New England's largest publicly traded bank holding company.
Exactly. And just to set the ground rules, we're looking strictly at their Q2 2026 earnings press release and their consolidated financial statements. No outside fluff.
Right, just the raw data.
Our mission is to figure out exactly how they are pulling off these massive numbers because in this economic climate, it really shouldn't be happening.
Oh, it should. It really is quite a puzzle to put together when you look closely at the mechanics. You know, when a bank posts record-breaking numbers right now, the immediate reaction is usually just to applaud the headline and move on.
Sure.
But for anyone, seriously interested in how businesses actually operate, the real value is dissecting the how and the why. We need to look at exactly how they manage their liabilities.
Right, without taking on toxic risk.
Exactly. And how they are expanding their margins when the broader banking sector is, frankly, often struggling just to tread water.
Yeah, we want to decode the actual mechanics, not just read the scoreboard. So, looking at those headline numbers, they are substantial.
Very.
That diluted EPS of $1.35, and just be clear for you listening, diluted EPS is the really conservative metric.
Right. It assumes everything converts.
Exactly. It includes every stock option, warrant, or convertible bond that could potentially become a share. It's the true bottom line number.
It's the most honest number. And that 5% sequential jump from Q1 is very healthy.
Yeah.
But to really appreciate the scale of the transformation happening at this bank, you have to pan out. You need to look at the first half of the year as a whole.
Oh, the year-over-year comparison is striking. So for the first 6 months of 2026, net income hit $44.9 million.
Yep.
Compare that to the first 6 months of 2025, which was just $21.4 million. Diluted EPS jumped from $1.26 all the way to $2.64. I mean, they essentially doubled their earning power year over year.
It is a complete night and day comparison. And to understand that specific leap, you really have to look at the defining strategic move they made recently.
The acquisition.
Yeah. The primary catalyst for that outsized baseline jump in 2026 was the successful integration of Northway Financial, Inc.,
which they acquired back on January 1st, 2025.
Right. What you are seeing right now is the fully realized earnings power of that combined institution flowing steadily through the income statement.
Okay, let's unpack this, because I think the Northway acquisition needs a bit of a real-world translation.
Sure.
We hear about bank mergers all the time, but what does it actually look like mechanically?
Well,
think of Camden National's core business as a really reliable, efficient car engine.
okay.
It was already running well,
Right.
Acquiring Northway was essentially like bolting a massive turbocharger onto that engine.
I like that analogy.
In banking terms, a turbocharger means you are acquiring an entirely new customer base, an established physical footprint, and this massive portfolio of loans overnight.
Right. All without having to spend individual marketing dollars to win those customers one by one.
Exactly. It fundamentally changes the baseline horsepower of the entire operation. It gives them more scale and a much higher floor for what a normal quarter looks like, which totally explains why 2026 is blowing 2025 out of the water.
What's fascinating here is that while the turbocharger analogy perfectly explains the year-over-year leap, it doesn't actually explain the quarter-over-quarter growth.
Oh, wait, because the Northway boost is already in the Q1 numbers.
Exactly. We have to remember that integration is already baked into the baseline of Q1 2026. So that 5% sequential growth from Q1 to Q2 tells us something incredibly important.
Which is?
The core organic franchise is building its own momentum. They aren't just coasting on the coattails of a past merger. The day-to-day business of banking, taking in deposits, making loans, managing spreads, it's actively accelerating on its own merits.
Which naturally brings us to that traditional banking engine, the spread business, or net interest income.
Right, the core of it all.
So for Q2, net interest income reached $52.9 million.
Yeah.
That's a 1% bump from the first quarter. And their net interest margin, the NI, which is basically the markup or profit margin on their lending activities, it actually expanded.
By 2 basis points, right?
Yeah, it reached 3.26%. And for context, a basis point is just 1/100%.
It sounds microscopic.
It does.
Yeah.
2 basis points sounds like nothing, but when you apply it across a multi-billion-dollar balance sheet, it represents real, tangible money.
Absolutely.
But as I was reading through the balance sheet, I hit a number that made me stop and question the math entirely.
Oh, yeah? The deposit number?
Yes, total deposits at the end of the quarter were $5.6 billion,
Right.
which is actually down 1% from Q1. Wait, how does a bank expand its interest margin while its total deposits are shrinking by 1%? That feels like it breaks the laws of banking physics.
It really does seem entirely contradictory at first glance. I mean, usually, shrinking deposits means a bank has less fuel to lend out,
Right, so you have to either borrow expensive money or just stop lending.
both of which totally crush your profit margins. But this is where we have to look past the top-line deposit number and examine the underlying mix of that money.
Okay.
It's all about the cost of funds. Camden didn't just lose random deposits, they intentionally optimized their funding mix.
Optimized how?
Well, in the banking world, not all deposits are created equal. Some are cheap and reliable, and some are very, very expensive to hold.
Wait, what makes a deposit expensive? Isn't cash just cash to a bank?
Not at all. Let's look at brokered deposits as the prime example.
Okay.
Broker deposits are essentially large blocks of funds that a bank buys from a third-party broker to quickly raise liquidity.
So it's not a local person walking into a branch.
Exactly. Imagine a broker aggregates $50 million from investors nationwide and shops it around for the absolute highest yield.
Got it.
If Camden pays top dollar, they get the cash. But the second a bank down the street offers a fraction of a percent more, that money vanishes.
Ah, so it's mercenary money.
Highly rate-sensitive mercenary money. It's often called hot money. And because the bank is paying a premium for it, it heavily drags down their profit margins.
So they got rid of it.
They did. In this quarter, Camden shed a significant amount of those. Their brokered deposits dropped by a staggering 23% quarter over quarter.
Wow, 23%?
Yeah. They also saw a 3% decrease in certificates of deposit, which are another higher cost liability. So they are actively, deliberately flushing the expensive money out of the system.
You know, this makes so much sense when you connect it to what you are probably seeing in your own life right now.
How so?
This is exactly why you've probably seen your own local bank suddenly pushing 4 or 5% high-yield savings accounts.
Oh, absolutely.
They are desperate to keep your sticky, loyal money in-house so they don't have to go out and rely on those expensive, volatile brokered funds we just talked about.
That is precisely the connection. And it's the second half of Camden's strategy. While they let the expensive hot money walk out the door, they held their core customer deposits remarkably stable.
Through those high-yield products.
Right. Largely by driving growth in a high-yield savings product, which helps them retain loyal, local customers without paying the extreme premiums of the brokered market.
That's smart.
Now take that lower overall cost of funding and pair it with what they're doing on the asset side. While total deposits shrank, total loans actually grew by 1% to $5 billion.
And it wasn't just any loans. The growth was highly targeted.
Very.
They saw a 7% increase in home equity loans and a 4% increase in commercial loans.
Exactly. And why does that matter? Because commercial loans and home equity lines of credit are typically much higher yielding assets compared to, say, a standard 30-year fixed mortgage.
Yeah.
So if you summarize the maneuver, they're paying less interest on their deposits by shedding the expensive brokered funds, and they are earning more interest on their loans by growing higher yield portfolios.
Shrinking liability costs and growing asset yields.
Exactly. That is the textbook, pure play recipe for net interest margin expansion. It requires immense discipline, but when executed well, it allows a bank to grow its profitability even if the sheer volume of its deposits slightly contracts.
It's essentially a masterclass in prioritizing quality over quantity on a balance sheet.
It really is.
It's highly disciplined, but it leaves me wondering how long they can play defense on deposits and offense on loans at the same time.
It's a tightrope.
Yeah. That optimization explains the 1% bump in net interest income. But as we know, you can only cut your funding costs so far before you hit bone.
Right, there's a floor.
Exactly.
Yeah.
A 1% bump in interest income doesn't alone get you to a massive record-breaking quarter. To do that, you need a serious revenue kicker.
You do.
Something completely outside the traditional spread business. And that brings us to what I think is the most surprising metric in this entire report, the non-interest income.
Oh, yes.
Total non-interest income hit $14.5 million for the quarter. That is a 21% increase.
A $2.5 million jump.
compared to just the first quarter.
A 21% sequential jump in a single quarter for any revenue line item is incredibly rare for a mature regional bank.
Yeah,
It absolutely demands closer inspection to understand what drove it.
it really does. And looking at the breakdown, it wasn't just a one-off accounting fluke or like a lucky break. The growth occurred across the board.
Really, everywhere.
They saw increases in deposit, customer-related revenue. Their debit card income was up 11% quarter over quarter.
Nice.
And then there's the wealth and brokerage business. Assets under administration, or AUA, in their wealth and brokerage division hit $2.6 billion,
Which is huge.
up 13% year over year. Here's where it gets really interesting. Because when you say the words regional bank or community bank, most people picture a drive-through teller,
Free checking accounts, yeah.
maybe getting a mortgage for a house down the street. They do not picture a multi-billion-dollar wealth management arm.
No, they definitely don't.
Camden is quietly running a powerhouse financial planning and brokerage division inside this community banking wrapper.
If we connect this to the bigger picture, this wealth management division is arguably the secret weapon for their valuation and long-term stability.
Really, the secret weapon.
Oh, absolutely. Let's think about why non-interest income, which is often just referred to as fee income, is so intensely prized by bank analysts.
Okay.
Traditional net interest income is highly vulnerable to macroeconomic forces totally outside the bank's control.
Right.
If the Federal Reserve rapidly changes interest rates, or if the yield curve inverts, traditional lending margins get squeezed, and there is very little a bank can do about it in the short term.
Traditional lending is extremely capital intensive too.
And highly cyclical.
Right. In the spread business, you are entirely at the mercy of the Fed and the broader economy.
But fee income, particularly from wealth management, operates on a completely different set of physics.
How so?
First, it's capital light. Let's say a bank holds a $1 million commercial real estate loan.
Okay.
Regulators require them to hold a significant amount of reserve capital against that loan just in case it goes bad.
Right. Tying up their cash.
Exactly. But if that same bank is advising a client on a $1 million stock portfolio, they don't have to hold massive reserves against that advisory fee. It generates revenue without tying up the bank's precious capital.
That's a huge advantage.
It is. Furthermore, wealth management revenue is inherently sticky. Once a client trusts an advisor with their retirement portfolio, or their business succession plan, or their family estate planning,
They rarely leave.
they rarely leave. The switching costs are just too high emotionally and logistically. This creates a recurring, highly predictable revenue stream that perfectly diversifies the bank's earnings.
It acts as a crucial shock absorber then.
Precisely. If local loan demand softens in a given quarter, strong wealth management fees can smooth out the earnings curve and keep overall revenue climbing.
It totally redefines the risk profile of the business.
Yep.
You aren't just betting on regional loan growth or housing markets.
Right.
You are capturing the overall wealth accumulation of your demographic.
Exact.
They charge a percentage fee on that $2.6 billion, and as the stock market goes up or as clients deposit more funds, that fee revenue grows almost automatically.
It's a great business model.
But speaking of risk, we can't just talk about revenue. Earning record revenues is fantastic, but we have to ask the hard questions.
Always.
What is the cost of doing business, and are they taking on bad, risky loans to juice these numbers? Let's look at the expense side first. Non-interest expense totaled $37.4 million for the quarter. That is a 5% increase from Q1. Now, a 5% jump in expenses might normally raise an eyebrow, but the report details exactly where that money went.
Yes. The context of that expense increase is entirely benign. The report explicitly ties it to expected seasonal factors that hit in the second quarter.
Like what?
Specifically, annual salary increases take effect, the timing of their annual director equity awards, and a recognition event for top-performing sales team members.
Okay, so pretty standard stuff.
These are normal, cyclical investments in their workforce and governance. They are not signs of structural bloat or runaway operational costs.
And the proof of that operational control is in the efficiency ratio.
Yeah, that's the key metric.
The GAAP efficiency ratio sits at a very solid 55.42%.
And just to clarify for our listeners, GAAP stands for Generally Accepted Accounting Principles.
Right.
It's the standardized rulebook that all public companies must follow. When a company highlights a GAAP metric, it means they aren't using creative math or custom adjustments to hide expenses.
It's not a fake number.
It's the pure, regulated number.
Exactly. And the efficiency ratio essentially measures how much it costs the bank to generate $1 of revenue.
So lower is better.
Yes. So an efficiency ratio of 55.42% means they are spending roughly 55 cents to make a dollar.
Which is great.
Anything under 60% is generally considered strong for a bank of this size.
Yeah.
But where I really wanted to dig in was asset quality.
Oh, this is fascinating.
We are in a weird economic moment globally. You can't open a financial paper without reading concerns about consumer credit card debt and the impending doom of commercial real estate.
It's everywhere.
But Camden's asset quality metrics are almost absurdly pristine. Non-performing loans, which are the loans that are seriously defaulting, are just 0.24% of total loans.
Tiny.
Past due loans are only 0.15%. And their annualized net charge-offs, which is the actual money they formally wrote off as uncollectible this quarter, is a microscopic 0.04% of average loans.
Microscopic is definitely the right word. Think about the math there. A 0.04% annualized net charge-off rate essentially means that out of a $5 billion loan portfolio, the actual realized credit losses are nothing more than a rounding error. It speaks to an incredibly conservative and rigorous underwriting culture. They're not chasing yield by loaning to marginal borrowers or taking wild swings in risky commercial sectors.
And despite how pristine the loan book is, they are still heavily provisioning for a rainy day.
Very heavily.
This is where it gets really conservative. The allowance for credit losses, often called the ACL, sits at 0.91% of total loans.
Okay.
Now, comparing that 0.91% reserve to their 0.24% in actual non-performing loans gives them a coverage ratio of 3.8 times.
That's huge.
So what does this all mean? Think about it like this. It's like keeping 3.5 umbrellas in the trunk of your car when there's barely a cloud in the sky.
Great analogy.
They have 3.8 times the cash set aside than they currently need to cover every single bad loan currently on the books. It shows a level of caution that is really rare.
It really is.
They are generating record profits while simultaneously building a fortress around their balance sheet.
This raises an important question, though, for any investor or observer. What comes next?
Right.
You have a clean balance sheet, you have optimized your deposit base by shedding hot money, and you have record earnings. Can this growth be sustained, or have they squeezed all the juice out of the orange?
It's the multi-million-dollar question.
The data in this report suggests the answer is yes, they can sustain it, primarily when you look at their forward indicators.
Okay, let's hear.
The most telling metric here is the committed loan pipeline. They ended the second quarter with a committed loan pipeline of $185.7 million.
Wow.
That is a 45% increase from the prior quarter.
A 45% jump in the pipeline is a phenomenal leading indicator.
It's huge.
That is future revenue, legally committed, just waiting to be funded and pushed onto the balance sheet.
Exactly. And the reason they can confidently look at funding a rapidly expanding pipeline without stretching themselves dangerously thin is their underlying capital position. Right. They are sitting on a Tier 1 risk-based capital ratio of 13.48%.
And for context, Tier 1 capital is a bank's core equity capital. It's the highest quality, most liquid safety net they have.
Regulators watch this number obsessively. If a bank has $100 in risk-weighted assets, a 13.48% ratio means they hold roughly $13.50 of pure equity to absorb any unexpected shocks.
Which is the top.
That is well in excess of all regulatory requirements. It means they have abundant excess capital. This strong capital position gives management incredible optionality.
Yeah, their choices.
They have the flexibility to fund that 45% larger loan pipeline, absorb any unforeseen economic shocks, and concurrently return capital to shareholders.
Which they are actively doing. They aren't just sitting on that capital.
Yeah, they aren't.
They repurchased 52,000 shares of common stock at an average price of $47.64 during the quarter.
Essentially betting on themselves.
Exactly, and reducing the number of slices in the pie for the remaining investors.
Yeah.
On top of that, they declared a 42-cent per share dividend, which shakes out to a highly attractive 3.10% annualized yield.
Really solid.
They are firing on all cylinders: organic growth, intense defensive underwriting, and consistent shareholder return.
It truly is a triad of strategic success. First, you have the lingering elevated baseline from the successful Northway integration, which expanded their footprint.
Right.
Second, you have the masterful active optimization of deposit costs, trading out expensive brokered funds for loyal core deposits to protect and expand that net interest margin.
Huge move.
And third, you have the surging momentum of a capital-light, highly sticky wealth management division diversifying the revenue stream away from pure interest rate risk.
It is a remarkable look into how a regional bank can outmaneuver macroeconomic headwinds.
It really is.
But as we wrap up today's analysis, there's
Yeah.
one detail that I just can't stop thinking about.
Yeah.
It's something that wasn't explicitly spelled out in the management commentary, but it's right there in the subtext of the numbers.
Okay, lay it on me.
We are living in an era where massive Wall Street megabanks absolutely dominate the financial headlines.
Oh, totally.
We constantly hear about consolidation, the death of the community bank, the rise of fintech apps.
Right, the doom and gloom.
Yet, here is Camden National, a regional bank in northern New England, quietly managing $2.6 billion in individual and family wealth.
Yeah.
It suggests a very powerful, quiet shift in the market.
A shift towards local.
Are high net worth individuals increasingly looking for the personalized touch, the local accountability, and the stability of a regional community bank over the impersonal algorithms and massive call centers of financial behemoth?
That's a great point.
If this $2.6 billion wealth management footprint is any indicator, the future landscape of wealth management in regional economies might look very, very different than Wall Street assumes.
Definitely.
Something for you to mull over as you look at the banks operating in your own community. Thank you for joining us on this deep dive into mechanics of Camden National Corporation's record quarter. Keep questioning the headlines, keep looking under the hood, and we'll catch you next time.